the Division of Financial Regulation, which does a lot of things, but the big piece that it does is licenses and regulates the insurance industry. And so now I get to go out and talk to people about how much we all hate insurance. I'm just kidding, but insurance is tough. I mean, it's a tough industry, but provide education, resource information, sometimes some tips and tricks to help kind of navigate the process, because it's difficult and it's frustrating as heck. So we're gonna get into that, and I'll take whatever question you want, but don't hit me, okay? All right, again, DFR, what we're about is providing information and education, and really it's the primary thing is to make sure Oregonians are treated fairly, because there's a whole bunch of revised statutes and laws around insurance and other financial institutions that we regulate, and we want those providers to be following the contracts that they engage with all of us in and the law. And if they're not, we want to rein them in or get them out. And we rely a lot on consumers to help us do that, to say, hey, my insurance provider is giving me false information. So it's not about tattling, it's about making sure that you're being treated fairly and have resources to figure that out. How it's structured, we're part of the Department of Consumer and Business Services, or DCBS. It's a bunch of alphabet soup, but it's the largest consumer protection agency in the state. It's got 5 divisions: the Building Codes Division, which makes sure buildings meet a certain code, OSHA for worker safety, our division, I'll tell you a little bit more about that in a second, and then the Workers' Comp and the Independent Workers' Comp Board. So that's the 5 groups that make up DCBS. And at the top of that is Andrew Stolfi. He's the Commissioner of Insurance and the head of DCBS, really nice, intelligent guy. I would tell you this, I'm not gonna say send Andrew nasty emails and say you're all upset, but if you have legit feedback, provide feedback, give feedback. It's what we can do as consumers, to the commissioner, to your representatives, to whomever. Our voice is the most powerful thing we have, and use it, because I'll take your input and I'll take it back, but your individual input about issues that concern you are super important. So please do that. All right, DFR. If you don't take anything from me today, this sheet or this slide or this little pamphlet over on this table will tell you what DFR does and what we represent. These industries here about insurance and financial services. Insurance is at the top because that's the bulk of it. It really is. And I think that's why you're all here. That's what the darn presentation's about. But it's also about investment and mortgage services and payday lending and whole bunch of other stuff, and I'm sure some of you have either been exposed to scams or maybe even been scammed or get about 50 scam phone calls a day. We all get it, and the division supports education and resources for people who've been scammed. So that's another part of the thing that we do. Bottom of the list is data brokers. Probably don't know about this, but a law was passed in Oregon in early 2024 that says any industry or business that is using our personal information, government issued IDs, birth dates, social security numbers, even the biometric data that your smartphone is collecting, if they take that data and they're using it, they're monetizing it, they have to register with the state, and then consumers get to see who is registered and can then opt out. So it's all intended to help protect consumers and give consumers options. Let's talk about insurance a bit. Last piece, consumer assistance. That's this little brochure right here is about advocacy. If you've got any questions about financial services or insurance, and you've worked with your agent or your carrier, and you feel like you're just getting the runaround, or you feel like you should have had a claim covered that's not, or you've read through your insurance contract and it's making you go to sleep, I tell you, I hate them. I mean, I was an agent and I'd read through those contracts and I couldn't figure out what was covered. They're difficult. And don't be embarrassed. Call, ask questions. That's what the advocates are there for. It's not just a call center of people that are paid $15 an hour to read through a script and tell you an answer. They're experienced. They have come from the insurance industry. Some of them have been agents. Some of them were underwriters. So you're talking to people that have a perspective of private industry experience that are now operating on the side of providing consumer assistance. Our advocacy team helped just shy of 18,000 consumers last year, resolved a little over 5,400 complaints, but in that returned over $8.9 million to Oregon consumers. Real money back to Oregon consumers, whether it was because of premiums that were being charged too much or claims that should have been paid. Real money back to Oregon consumers. So if you feel like you need help, call them, it's free. Or go online, send an email, it's a resource that's there. On our website, there's a ton of material and brochures about insurance, about investing, about all sorts of stuff. We're not going to tell you what you should do. It's just information because it's all free choice. We all going to do whatever the heck we want to do, but we just want to make sure we all have access to information, and there's a ton there. So you can check it out. That QR code will work, or you can just go to the dfr.oregon.gov, and it's a bunch of stuff there. All right, insurance. We all know Oregon, right? It's a beautiful state. It's got amazing geography, but with that comes a little bit of risk. We've got mountains and windstorms and ice. We've got rivers and ocean, and we got a ton of rain. Roll back the clock a couple weeks ago where we had the atmospheric river coming in, and it rained and it rained and it rained and it rained, and there's been flooding. I've been getting phone calls from Malheur County because they've had massive flood issues back there, and I'm probably going to end up in Ontario in the next couple days, servicing communities over there. So, and then wildfire. Of course, we all understand wildfire. Oregon has had an incredibly rough wildfire decade in the 2020s. And last year was a record-setting year in wildfire, over 1.9 million acres, which was horrible. So these are real risks. And then if you believe it, I believe it, we're on the Cascadia subduction zone, and an earthquake is going to hit us at some point. And when it does, it could be horrible. You know, you could see a big chunk of land fall off into the ocean. You could see a bunch of houses fall off their foundation, or you could just sit there and rumble. We don't know. But if you have a house that's not built to earthquake standards, and you're not insured, and it falls to the ground, your homeowner's insurance is not going to help you one bit. So my point in saying that is not to say, haha, you're in trouble, is to say plan now, because the day after something happens is not the day to call your insurance agent and say, hey, can you get fire coverage on my house that just burnt down? No, that's not going to happen. You know, and I'm not trying to be flippant about it, but it's really important to try and plan ahead. It's about preparedness and about decisions. We all have a different risk tolerance. Some people might say, I'm not worried about it. I can live with this. And others are happy to pay the premium and understand that what goes along with that. But insurance is a tool to use, but like with everything else, there is a trade-off, there's a cost associated with it. Here's the one that's going to make everybody scream, makes me cry. This is a catastrophe chart of claims paid out by insurance companies in Oregon alone. Hard to see, but I'll kind of run through it. It's by decade. 1980, far to the left there. You really can't see anything because there wasn't anything paid out in the 80s. 90s, not much there. 2000, not much. 2010, not much. 2020, everybody see a difference? All right, so the pink line is wildfire. Almost $3 billion paid out from 2020 through 2024. You got green is winter storm, and yellow is wind and thunderstorms. So those three types of catastrophes from 2020 through 2024 are over $4 billion paid out by insurance companies. If you wanted one single answer as to what's going on in the insurance industry, it's that. Because when the insurance companies pay out that boatload of money, they are then required to look at the policies they're holding to say, do we have enough money that we're hanging on to, or policies that we're hanging on to cover those policies? And if they don't, which they don't because they just paid out $4 billion, they have to adjust their rates. And it happens every year. Oregon is what's called a file and use state for rates, which means every year, every carrier has to look at their, in detail, not just like, well, we think 50%. In detail, they have to look at exactly what they paid out, what their exposure is in policies, what the projections are for future payouts, submit that to DFR saying, hey, we think our increase needs to be this to cover our policies. They file that, and then they can use the rates. DFR reviews that, and if they're absurd, then they're going to get flagged and it's going to get stopped. That's why there's a big variation with some carriers. You might find that one carrier, you get a renewal and it says you're going up 60%, as an example, and you go shopping somewhere else, and another carrier gives you a rate that was only an increase of 20%. Every carrier has a different exposure. They're not all the same. And so not every carrier is going to have the exact same rate base. So it's really important to shop because they're not all the same. Okay? But this is the crux of what's going on in the insurance industry. And someone may ask, but I'll head it off. Rates are only claims paid out in Oregon can only be used in Oregon to affect their rates. So they can't go and look, oh, we paid out this much in Florida, or we paid out this much in California. They only get to apply what they paid out in Oregon. They can apply their knowledge of things that occurred in other states, like, hey, that sort of material used is creating problems, so they can adjust their underwriting rules, but they can't take their true losses in another state and try and recoup it somewhere else. Not supposed to, by law. So, okay. So when you're evaluating your insurance, I mean, I'm not trying to tell people things they don't know, but I'm going to assume maybe some people gloss past insurance. Probably not now because it's so darn expensive. But you really need to understand what the coverage types are there, and you really should be reviewing it every year. When that renewal comes up, look at it in detail, make sure you have the right type of coverage, the right level of coverage, and take the time to ask some questions of your agent. And if your agent isn't answering your questions, get another agent. Because it's a service industry, and they're getting paid commission based on the premium you pay, and if they're not answering your questions, there's somebody else who can probably do a better job. I mean, you deserve better than to not be serviced. I was an agent. I made a point to try and help people, and I think you deserve to be helped. So you can ask as many questions as you want. Questions are free. Premiums are not, unfortunately. But gaps in coverage are a really concerning thing, because one of the things that we found out in the past couple of years of claims is that a lot of people were underinsured. So you think about a house that's worth $500,000, and it's completely destroyed in fire, but their policy was only written at $400,000. Insurance companies are not generous. They are not going to say, well, I see your loss is at 500, but your policy's at 4, we're going to go ahead and give you the extra. They're going to give it to the limit of the policy, and you're left holding a big old bucket of nothing. And I don't have $100,000 in my back pocket to fill that gap. So as a homeowner, it's our responsibilities to review and make sure that the amount on the policy is correct. The insurance companies do an automatic review each year for inflation factors, but they don't necessarily do it to say that it's exactly right for the house. They also don't know if you made changes. If you added on an extra 100 square feet, or if you remodeled the kitchen and you don't tell them, they don't know. So it's on us. We gotta be forthright and share information to make sure we have the right coverages and make the changes so that you're covered. About replacement cost, there's lots of ways you can get estimates of that. Every insurance company has got their own replacement cost estimating tool. That's why when you shop, they ask you 800 questions, and you're like, why am I getting the Inquisition? It's because they want to know that they're preparing a policy that's going to match your needs. So they're going to ask about square footage and material type and floor coverings, and you're exhausted by the time you're like, why? Because they want to know. But you can also ask a contractor. You can do online estimating tools, but you have a right to challenge it too. If your insurer says, hey, we did an estimate and we think your house is worth $375,000. You're like, that seems absurdly low. I did an estimate and I think it should be at $450,000. You can challenge them. You can provide a basis as to why you think it should be higher, and you can generally get a higher level of insurance if you want. But again, if you're wanting a different amount than what's on the policy, you need to make sure you make that challenge. You'll also see variation between carriers because they use different tools. So State Farm might come up with a number that's here, and Travelers may come up with a number that's here, and Safeco may come up with a number that's here. If they're relatively close, not that big of a deal. But if you're talking about 20 or 25% variance in the pricing at the level of coverage, that's a big deal. And you really need to stop and say, something's off here. Somebody missed something. And again, you want to make sure you're covered at the right level. On a policy, this is an important one. Things that are typically covered. And I say typically because not every insurance policy is the same. I wish they were, because it'd be really simple to say you're going to have this, 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 and this. I will tell you this. Oregon is a standard fire state. That means that fire is covered. Wildfire, kitchen fire, chimney fire, fire. Fire's covered. The only fire that is not covered is the one you lit yourself. If you burn your house down, you're not getting that covered. Seriously, intentional acts are not covered under insurance. They're going to tell you to get stuffed. But fires is covered. So we have heard reports of some insurance companies reaching out to people during wildfire season saying, hey, I want to let you know your property's not covered because of wildfire. That's not cool. They can't do that. Oregon's a standard fire state. Now, there is some legislation that's being proposed that would allow the peril of wildfire to be pulled out, potentially being put as a separate policy, but that doesn't exist right now. Right now, fire is the first peril listed, peril meaning something that could cause damage to your home. It's covered, unless it is not. So you want to make sure you read your policy, and it's going to be there. Fire is covered, along with things like weight of snow and ice and wind and power surge and falling objects and theft and vandalism. A typical homeowner's policy, which has broad coverage, usually has like 14 perils that are listed. I don't list them all because you kind of go, oh, that's crazy. But these are the big ones. So when you read the policy, you want to make sure you understand what's covered, what's not covered. What's typically not covered is earthquake, flood, landslide, tsunamis, and sinkholes. What those all have in common is effectively anything to do with earth movement or the earth. When you get a homeowner's policy, you are not insuring the dirt that the house sits on. You are insuring from the foundation up, the sticks that are built it, the bricks, the structure. Yeah?
Are the associated risks of fire, smoke damage, water damage typically included?
Yeah.
Okay.
Yeah, typically. And again, I'm glad you said typically, because every policy may have their own little nuance that they want to layer in there. But yes, typically it's going to be included. And so generally what happens with an insurance policy, they're going to go back to proximate cause of loss, which means what was the original cause of this loss? If it was fire, and fire caused this to happen, and then that caused the water damage, yeah, that's going to be covered. Also could be said, well, if it was flood that caused damage to happen, and then that damage caused a fire, and you don't have flood insurance, you could be hooped. So that's why it's important to understand what you don't have on your policy. And why I say typically, because if you go back in time, maybe 10, 15 years ago, a lot of carriers actually would endorse earthquake on a policy. And maybe some of you might have an older policy that's been around for a while, and if you looked at it, it may actually have earthquake on it, which is great. But if you go shopping right now, there's only a handful of carriers or less that are offering earthquake on the homeowner's policy. You can get earthquake insurance, but it's a separate policy from a different carrier. And you can get flood insurance, either through NFIP, which is the National Flood Insurance Program, or a couple of independent carriers. And if you do NFIP, you're going to pay this much, and if you go with an independent carrier, you're going to pay this much. But you're going to get a lot better coverage with the independent one. But understanding that those are not going to be on your policy, so don't assume, I'm good, I'm covered. No, you're not. And the other thing that's on there is wear and tear. Insurance is not a warranty. So a lot of folks say, oh, my house, my roof wore out, I'm going to make an insurance claim. They're not going to cover it. If a tree fell through your roof, they're going to cover that probably, but not if it's a 35-year-old roof and it's just leaking because it's 35 years old. So it's our responsibility to maintain our homes. All right, not to belabor it too much, but again, the dwelling, it's what it would cost to replace the house. If it disappeared tomorrow, if it burned down, if it got knocked over, whatever, if it was gone and had to be rebuilt, that's the coverage on your policies for the dwelling. And again, we need to make sure we understand what that amount should be and challenge it, all right? There's a way to get the right amount of coverage and maybe a little bit more, and it's not by saying, well, I want a buffer. I know the replacement cost is $500,000, but I'm going to actually increase it to $700,000 because I want a nice fat buffer. What that means, if you do that, if the insurance company lets you, you're paying for an extra $200,000 of coverage all the time. Now, I'm not going to tell you how to spend your money, but my advice would be don't, because that's a waste. The right way to do it would be get the right replacement cost and then add an endorsement on the policy, which is extended replacement, which means they offer a percentage of 25% or 50% or 100% of that replacement amount, and it kicks in if there is a catastrophic loss. So let's say you had a fire, took out your house completely, and your policy was written at $500,000 for dwelling coverage with 25% extended replacement cost. Often when there's a disaster and more than one home is impacted, what happens to material costs? Anybody? They go way up. What happens to the cost of labor? way up. So costs go up, and all of a sudden your $500,000 doesn't go as far as it used to. So you need more. That 25% now becomes available, up to 25% more, and in that case, it's an extra potential $125,000. You're not paying for an extra $125,000 all the time on the policy. You're paying for the potential possibility of tapping into 25% if it's needed. It's a much less expensive way to get buffer. Way better way to go. So if you need it, talk to your agent about something like that. Again, you can get it quoted, and quoting is free. And if they won't quote you, challenge them. They should be doing that stuff for you. They should be servicing you. Other structures. This is an important one. Your dwelling structure is just the house itself. Other structures is anything else on your property. You've got fencing, you've got a barn, you've got a detached garage, sometimes decks that are not attached to the house. But detached garage is an important one. Again, some people consider my garage as part of my house. It is if it's attached by a wall or a roof line. If it's physically detached by itself, you have to have enough coverage for that under the other structure as part of your policy. Super important. So I've seen some really nice other detached garages that have maybe an apartment in them or an office that are done up inside, and it might take $200,000 to replace that garage. And you may only have $50,000 on the policy. So again, make sure you have the right amount of coverage under other structures. Contents, it's our stuff. You know, your clothing, your housewares, your furniture. So again, you want to make sure you have the right amount there, but be mindful that there are certain categories that are going to have caps. And again, each policy is going to be written a little bit differently. Typical things that are going to be capped: jewelry, firearms, cash, collectibles, fine arts. And usually that cap is somewhere around $3,000, maybe $5,000. So if you've got, let's say you're a hunter, you've got 6 or 8 rifles and a few pistols in your gun safe, and you were asked to say, what are they worth? Oh, that's worth $12,000. And your policy has coverage up to $3,000. If you're okay with that $9,000 gap in coverage, great. If you're not, you want to talk to your agent and make sure you do something about it. Same thing with jewelry. If you've got $20,000 worth of jewelry or diamonds or a fancy watch or something along those lines, and your policy has a limit of $3,000, you want to be aware of that risk and either adjust your policy or accept the risk. But know that you're not going to get paid for the amount above what the policy limit is. Okay. LE, or additional living expenses. This is also called loss of use on some policies. It's a really important one, and that is because occasionally something happens on your home and you can't live in it. You get a fire damage, you get a tree falls through it, and you need to be out while it's being repaired because there is a covered insurance claim doing that. When that happens, the additional living expense coverage kicks in. That's going to pay for you to live somewhere else, a hotel bill, apartments. That additional expense for you to be out of your home would be covered by the policy. It's going to have a limit based on the policy, how it's written, and it's going to have a time frame limit. Generally, it's no less than 12 months, could be as much as 24 months for you to tap into it. There's legislation in Oregon that says if there was a disaster declaration, that ALE automatically goes out to 24 months. So that's helpful. But you want to look and see what the limits are. The other thing that's important to understand about ALE is that you're still obligated to pay, if you have a mortgage, you got to pay your mortgage on the house that's being fixed, and you got to maintain utilities there so that like pipes don't freeze, that sort of thing. So it doesn't cover your normal expenses, it covers your additional expenses if you had to live somewhere else. Make sense? Okay. Hard to see this. This is an example of a deck page, a declaration page, but they're typically broken up into sections. Property section, which is going to be dwelling, coverage A, other structures, personal property, loss of use. And if a nice one that's structured properly is going to show you the limit of the policy and the deductible, and then what the premium is. This is really common that a premium is associated with the dwelling, but it's including a bunch of the other subcategories as well. So you don't necessarily get a premium for, well, what's my loss of use premium? It's all rolled up into one, so it's kind of hidden. The other thing you'll see is that other structures in this example is 20,000. That's 10% of the dwelling. That's a really standard, like if you were to get a policy quote, you're going to get 10% on other structures. You're going to get maybe 50% on personal property. and 20% on loss of use. Just as out of the gate, that's how it kind of gets spit out of their system. You can change it. You can say, no, I need more for other structures, or I don't need that much for personal property. So you can make adjustments, but by standard, that's how they get issued. So, and typically you can't take like personal property to zero. You're going to have a minimum amount of coverage on some of these areas. But you can ask your agent, say, hey, show me what it would be if I do this, this, or this, to see what the impact on premium is. The final section down here is liability. And this is about actual or alleged injury that you caused to somebody else. So it's pretty cheap. In this case, it's $300,000 per occurrence if you're accused of harming somebody. And it could be all sorts of harm. It could be actual physical harm. It could be like slander, potentially. People sue people for all kinds of stupid stuff. But if you actually do harm somebody, as an example, maybe you're out at the golf driving range and you slice one off the range and slam it through somebody's car, that would actually come off your home insurance policy if you wanted to claim it. That'd be a way to do it. Medical insurance, payment to others. Again, if someone got injured on your property, you would get that in various increments, $5,000, $10,000, $15,000. And then this has an example of an additional coverage or a rider for jewelry. The limit was increased to $10,000. So just kind of shows you how it might be structured. And then it lists the discounts that are applied to the policy. But what's important to note is it doesn't tell you the actual amount. It just says, oh, by the way, you're getting a discount because loyalty, meaning you've been a customer for however long they decided that was loyal, and you've got multiple policies with us, or you've got home security system or storm shutter. So they're listing things that they have qualified as being discount eligible, but they're not telling you what the discount is. That's really common, and you're probably not going to get an answer as to, because we want to make more money this year. They're going to get flagged, and it's going to be, that's excessive, you can't do that. If they do the reverse and they say, hey, we calculated it's 30%, but we're only going to do 15% because we want to take market share from our competitors and grow our base. No, you can't do that either because that's not adequate. That's not going to have enough coming in to cover the policies that you're holding. That doesn't meet the state guidelines, puts people at risk. So those are pretty easy ones for the regulators to measure. The unfairly discriminatory one is much harder because the way insurance works is for like risks, they have to offer same rates. But like risks, there are so many factors. You can say, but I have the same value house in the same neighborhood. Sure, that makes sense. But all these other factors come into play, which are your claim history and your credit history and this and this and this. And it starts to make the risks different. And so it becomes difficult. What we want is for when people are experiencing excessive rate issues that they reach out to us and they tell us so that we can investigate it and regulate it and find out if they actually are abusing the system and get that money back for consumers. Here's an example of some of the factors that come into play. Replacement cost is a big one. What's it going to cost? That's the big piece, what should be on the policy. The location, physically where it's at, there's a lot of factors with that. Crime comes into play. Distance to a staffed fire station obviously comes into play. And insurance companies generally refer to that level of protection from fire as a PC or protection class. And protection classes that are at the PC like 6 and below tend to kind of fly through no problem. You get up in the PC 7, 8s, they're like, and 9s and 10s, they run away screaming. They just don't like to issue policies on protection class 9s and 10s. And to be candid, the reason is this. If they issued a policy on a PC 10 home, meaning it's going to take a long time by their standards to get someone there if a fire gets reported, it's probably going to be a significant or total loss, which means they're going to write a big old check. And since they're a private industry, they don't want to do it. So they opt to say, we don't want to take that risk on. And they get to say, we don't want to take that risk. Don't hit me. Construction type. Is it stick built? Is it brick? Is it built on a basement, slab foundation, post and pier? All sorts of weird stuff that comes into play about how homes are built. Or is it a manufactured home? A big consideration. Its age and condition. All those things. Those are all property related, but then you get to the personal stuff about us, our credit history, our insurance history which is converted to an insurance score. So if you haven't had insurance before, there are some carriers that are like, yeah, we really don't want to be your first venture into insurance. Go cut your teeth with somebody else. On your claim history. So you get a score associated with you that's called your insurance score. And each carrier kind of quantifies that a bit differently. Claim history is a huge piece of the puzzle here, and this one kind of drives me nuts. They go back 5 years on property policies, and you think about, fine, I've been in my current house 3 years and I haven't had a claim there. But they're going to go back 5 years, so they're going to go back to where you lived prior to that, and they're going to look for claims there. If you happen to have, let's say you have an investment property or a rental home that you owned, any claim that is associated with that property is subject to your current insurance rating. So anything associated with a property policy in your name that has a claim associated with it within 5 years is going to affect your rates. And if you're shopping for a home and you're looking at a house and it had a water claim 2 years ago, that claim is going to be potentially part of the rating factor, because all of these things can contribute to a potential future claim per the insurance wisdom. All that junk gets thrown into their statistical database of how they do it, and they come up with rating. Each company has a different algorithm that they use, whether it's USAA or State Farm or Travelers, but as long as they apply it the same way to everybody, then they're within the guidelines. But that's also why you find that some carriers will issue a policy and some won't, because they have a different risk tolerance themselves. Yeah?
I was previously insured with Amica, and in '23, got a renewal notice with a 500% increase in my premiums.
Uh-huh.
We had had no claims in 21 years with them or anybody else. And I, in speaking with them, was essentially told we're trying to skinny down our portfolio of homes near wildland.
Yeah, well, that was kind of their shady way of saying we don't want your business anymore.
Right, and they more or less acknowledge that, but my question to you is, does the state of Oregon find that excessive at all?
Yeah, absolutely.
So had I come to you in '23, what relief might I have expected?
Well, there would have been an investigation done to say, how can you justify 500% increase, and is that being applied equitably across everybody else in the same situation? And who knows how that would have come out, but if they couldn't have done that, they would have either been fined, probably they would have been fined. If it was like really egregious, they get fined, they get maybe fined a massive amount, and then if it's horrible, they get their licenses revoked. And we're not in business to fine, to collect money, and to kick people out of business. The point is to make sure that what they're doing is within the law and treating people fairly. It just so happens that sometimes those that are outside the lines get a consequence. So that's what would happen. So you kind of segued into this point, which is we all get renewals every year, and sometimes the rates go up and you go, oh my gosh, it's too high, or you get a non-renewal. And I think the first thing I would say is take that breath, swear under your breath or whatever you need to do, and then ask the company why. You can ask for that in writing, and you should. You want the detail. What's the basis for the increase? Because you want to know if you can make a change. If you can mitigate what the problem was, is it because the roof is wearing out? Is it because there's not a railing on the deck on the second level? Is it because of a broken window? I mean, is it something you can fix to retain the policy or bring the rate down? Then you should do it. Even if you can't retain the policy, you want to know what it is, because that's likely going to come up when you go shopping somewhere else. So you just want to be aware. But you can absolutely ask in writing what's going on. You also want to make sure you're getting all the discounts you possibly can. And again, this is where I want to keep pushing the point. Ask all those questions. Am I getting credit for bundling? If you're not bundling your stuff, I'm not going to say it's always going to save you money, but you should try. Push your stuff together. The more you push your business together, generally the cheaper it's going to be, generally. How you pay is a big difference. If you can pay it all at once versus paying it over time, it's a significant difference in total cost. And I get that some home insurance is absurdly high, but you could see a 20-25% difference in total cost if you pay it out over time. They're torturing us as consumers because you're basically financing with the insurance company. A big one, though, is asking to be re-rated each year. Because when a policy is issued for the first time, they run your credit score and they run your insurance score. And that's associated with the policy that's sitting there that's in force. They're not going to rescore you every year. They're going to apply a standard increases for inflation on the amount of the dwelling coverage, but they're not going to rescore it. You can say, I want to be re-rated. If your score gets better, it will affect the premium in a positive way and bring it down. If your score gets worse, they cannot use it on a current policy. So it does you no harm to say, hey, re-rate me once a year. Totally free. Just say, hey, I want to be re-rated. If you're shopping though, and you go to a new carrier, they're going to run your score and your number is what it is as of that moment in time. So beware. Look at coverage levels. We talked about that before. The dwelling has to be at the right amount. If your house replacement cost is $500,000, you need to be at $500,000. If you're at $510,000, whatever, that's fine. Don't be at $450,000. It's an automatic gap, and you're creating a torture for yourself. So be at the right level. But look at the other stuff. Maybe you're over-insured on your personal property, because sometimes what happens is the standard coverages are just more than we need, and you can make adjustments. That's also true of other structures. Sometimes maybe you don't even have other structures. I don't need coverage for that. You can take it to the lowest level possible, for instance. But probably the biggest one you can look at is your deductibles. On insurance policies, if you go back a few years ago, a lot of times they're sold with $500 deductibles. And the whole premise was, hey, if you have a claim, it's going to cost you almost nothing to get it submitted, no big deal. Well, the problem with that is lower deductibles equate to higher premiums. And your premium you got to pay. And the deductible, you hope you never have to have a conversation about, because that means you had a loss. So again, I'm not here to spend your money or write your checks for you, but if you ask for quotes at the higher levels, at maybe $1,000 or $2,500 or whatever level you want to go up to, you'll see the premiums come down. And whatever it comes down to, again, everybody has a different threshold that works for them. But it might make sense. You go, oh, if I go up from $500 to $2,500 on my deductible, my annual premium comes down to this. That makes more sense. That's the first benefit. The second benefit is it makes you really stop and say, should I submit this claim? Because if you're submitting claims that are at or below your deductible, you might as well just hit yourself in the head with a hammer, because all you've done is got a $0 claim on your record and no money coming back to you. That's the most non-productive thing you can think about doing. It's just not helpful. Now, what's the threshold when you should submit it? I don't know. I know a good example. You go away for the weekend, you come back and your water heater has leaked out and it's flooded your basement. Yeah, submit that one. That's 60 grand of water damage, and you don't got that probably. I don't have that. Those are the ones you submit. But the broken window that you can replace yourself or have somebody do for $300 or $400, that's not an insurance claim. That's going to torture you. If you've done all that and you still can't find with your current carrier that they can get your rates down, then shop. There's over 100 carriers in the state of Oregon. You can use that silly QR code, or you can go on our website, dfr.oregon.gov. There's a whole list of them. They are not all going to quote you. They're not, but it is a competitive market, and it makes sense to look. And I think you could find that you're going to find options elsewhere in the standard market. The standard market, again, are the national carriers. If you're getting denials from standard carriers, and you get 2 denials, that then would be the message to say, well, you need to go to either surplus lines. Surplus lines are carriers that are willing to take on higher risk stuff. It's full coverage. They're a little more specialized. It's going to probably cost a bit more, but it's going to be full coverage. And you would get to that through an agent. You would say, hey, if you have an insurance agent, I want to get a surplus lines quote. Again, they may or may not quote it. If they don't, the third and final option is going to be the Oregon Fair Plan. That's the insurance of last resort in Oregon. Some of you may be aware, maybe some of you are insured by it, I don't know. The intent is that, and a lot of states have a fair plan, that we don't want, any state doesn't want properties to go uninsured. And so Oregon has a plan in place that is, I'm running late, sorry. It's essential coverage. So it's going to give you on a standard residence up to $600,000 of coverage as the basic coverage, and then personal property and basic perils, fire being one of them. It's like, but it's a very stripped down policy. they have added a option for what's called wraparound with another carrier, and the wraparound adds in other coverages. So it gets it up to what would be a standard home policy. And yes, it costs more. So it's sort of an a la carte thing. As you add more to the policy, you can get more coverage and you pay more. So you can kind of see what makes sense. The thing about Oregon Fair Plan that is important is that I'm not their underwriter, so I don't represent them, but they take pretty much everything. If the structure is standing and it's got a roof and there isn't a wildfire burning in the backyard and you as a homeowner are willing to do something with respect to home hardening and defensible space, they're likely going to take that. And they don't care how old your manufactured home is. They don't care. So if you've exhausted every other option, call the Fair Plan.
Say that louder.
If you've exhausted every other option, call the Fair Plan.
1972 manufactured home.
Okay. And I've talked on this a few times. If you're shopping for an agent, one thing is you want to make sure they're licensed. You don't want to have some unlicensed schmuck trying to sell you insurance, because then you're going to get something that's not going to cover you. You can verify licenses and you can verify complaints about agents through DFR if you call the advocates. And if you don't take anything from my table over there, from me, there's a little brochure that has that number and the contact information for the advocates. But there's great information about how to verify agents there. And then, like anything else, like if you were getting a service done on your car, you want to make sure that you trust them. So talk to them. Maybe get a referral from a friend. I mean, it's like anything else. You want to make sure that there's a connection there. You don't want to give your business to somebody that you feel like is not hearing you. So, bunch of links. Nobody cares about that. We're on social media. Yeehaw. That's how you get a hold of us. The brochure is over there. And I'm more than willing to take all sorts of questions. If you want to take the survey, you can do that. You don't have to, it's fine. Yes, you first.
Is there any sort of regulatory action comparable to bank stress testing that can tell whether a carrier is sufficiently capitalized to cover their exposure or anything like that?
Well, yeah, there definitely is. So the DFR team that does the regulatory work on carriers is actively reviewing carriers constantly about that. So it's a big concern because, but that's also partly why Oregon is this file and use state, which allows them to calculate what rate increase they need to maintain their financial viability. And this is a touchy subject, which is probably going to make people crazy, but like you take other states where there have been some caps put in place, it puts in question the financial viability of the insurer. And so they will choose to survive for a while until they can't, and then they bail. Oregon doesn't want that to happen. But the trade-off is that you see rates going up, and it feels horrible as a consumer. You're like, oh my gosh, my rates are higher than I want them to be. So, sorry, Brian.
Just want to say thank you very much.